16 years that this program has been running, I've had the privilege of moderating 15 of them. I did not do number one, but I've done every one since then. Phil got in touch with me at some point way back when, and it's been great. The thing that I have found that is really quite remarkable in my own journey in understanding alternative investments is that when I first started doing the program and moderating way back when, what did I know about? Things, private equity, hedge funds, etc. Not much. And since that time, especially over the last 5-6 years, I've gotten involved more deeply into the process, including, as Phil mentioned, I've gone from having my own firm of Blue Marble Research and an association with a couple of partners in a company called Hedge Capital Partners, focused on private equity deals in South Central Europe, to now joining one of my partners from Hedge Capital Partners with Redmount. And the thing that I've noticed about the whole private equity space, which I'll just talk about very briefly here, sort of encapsulates some of the things with alternative investments that's kind of important to know. And when I did a Bloomberg radio segment a couple of months ago, I think it was at the end of June, that in it I talked about one of the elements, which is due diligence. So I thought that what I would do is just very quickly touch on what I call the 7 steps of a private equity deal and just elaborate a little bit on each one of them, and I think you might find it of help. I'm learning of this in real time. I'm doing this in partnership with a couple of guys who have been doing this for quite a while, and the learning curve is quite remarkable for me. So here are the 7 steps, and I'm just going to mention a little bit in each one, and then I want to get to the discussion with our panelists. Source the deal, due diligence, structure the deal, fund the deal, close the deal, manage it, and exit. Easy to say, okay? Several of those pieces are pretty easy. Fund the deal. If you already have the money, you can fund the deal. Close the deal unless the seller or the buyer gets cold feet at the altar. You should be able to close the deal. But the other elements that are there are not so easy. And let me just touch on 2 of them real quick. Sourcing the deal. If you source a publicly traded company to invest in, you do the research, you look into it, etc. Okay, you find that this is a publicly traded company that you want to put money into on behalf of your clients. Pretty straightforward. One of the things, in fact, previously Alvin was mentioning, Alvin, we were talking before, and that's what he loves about publicly traded companies, one of the features, which is, I can get out. Okay, but when you're talking about private equity deals, this is a reverse Godfather 3. Once you're in, you can't get out, okay? Or it's not that easy to get out. It's a 5 to 7 year process, sometimes it's 3 to 5 years, so you really want to make sure that when you're going in, that you're doing it right, and sourcing the deal starts the process off. And finding good deals are not easy. With publicly traded companies, you might look at 100 publicly traded companies. If you have a screen, you'll find 10 of them that you like and one that you invest in. But on day 2, 3, 4, 5, 7, 25, if you want to get out, you get out. But in the case of a private equity deal, when you're in that for a commitment period of time. So you really want to make sure that you've sourced a good deal, done the due diligence that's necessary to do. And those things, along with structure and funding and close and manage and exit, not that easy to do. The other element that I just want to touch on very quickly is manage the deal. You have to have the talent and the personnel that's there, that's going to manage the deal, that's going to be there working with management day to day. And there are a lot of things that through the due diligence process that if you didn't do properly in the beginning, stuff starts to happen. And it happens in the managing of the deal process. So let me just give you a quick example of one of the projects having to do with the South Central region of Europe, in which we were told in the beginning, reasonable as part of the due diligence process, that the maritime laws in this particular country were good. And it's true. In the United States, we kind of take law for granted. But over there, you want to make sure that whatever it is at the courts, they're good. In this case, it's true. Maritime law is pretty stringent over there in this particular country's case. But as it turns out, that in this particular country, there are 3 commercial courts in the country. And the one that has jurisdiction over this particular project that we are involved with is the one that has a 1-year backlog before your case will even be seen. Then you have the ability to have an appeal should you have difficulty with your partner, in this case the owner of the business, of giving up some of the assets of the company. And they can appeal, and that appeal process can drag out for years. Now, what does that all come back to? It comes back to due diligence. Making sure that you have done the due diligence in the beginning as thoroughly as you possibly can. Never accepting what you have received as gospel. Ask the questions, be a real pain in the butt, and thorough investigation right from the get-go. Now, these are just 2 areas: sourcing, difficult, finding good deals, which, by the way, one of my projects here in the United States with one of my partners, if anybody here has any good deals and any good ideas, come and see me. We're happy to take a look at what would be good deals. Sourcing deals is really, really difficult. And then the other part is the managing aspect of it. So I just wanted to kind of touch on that because there's tremendous opportunity and tremendous benefits, and we're going to hear some of that from our panelists here in a second, but there are also incredible challenges that are involved with it. And understanding that this is why you get paid well if you do the deals and structure them well, okay? You are looking at good double-digit returns, but you have to do the homework as thoroughly as you possibly can. So with that, what I'd like to do is kind of get into a discussion here. Why don't we go from outside in? Each one of you, please give a brief description of yourself, your firm, what you do. This is a good way of everybody getting to know who you are and all. And then we'll go into a discussion. I'll ask a few questions in more general terms, more macro strategy stuff, and then please think of the questions you want to ask, because that's the meat of this program. Knowing what it is that's on your mind, which, by the way, is very beneficial to all of us, because hearing about the kinds of questions that are out there becomes very, very informative for everybody. So, Ali, you have a microphone. You got to do the mic for the recording, etc.
All right. Hi, Ali Motamed in Vanomic Capital Management, and I am the portfolio manager for the Balter and Vanomic Fund. It's a liquid alts 40 Act traded fund. We are long-short equity managers in the U.S., running a variable long-short exposure, which basically means that that short book fluctuates up and down depending on the circumstances. So our goal is not to just have lower returns and lower risk, but to manage risk in times like now when it makes sense. So for example, now we're running a huge short portfolio against our long book, but there'll be times when we're almost fully invested, and it's kind of a quantitative and fundamental integrated approach.
Terrific. Garrett?
Hi, I'm Garrett Goggin. I'm an analyst at the Gold Stock Analyst. I cover most of the golds, and I cover all the silver mining companies. We generally use the current price of gold to model forecasts. We don't make predictions upon where the price of gold is going. We focus on the fundamentals of the underlying companies. I've been to many mine trips to up in Canada, Mexico, South America. We're close with the whole Canadian community. We know these companies inside and out. It's true, deep dive fundamental analysis to try to find, the value plays on a free cash flow to enterprise value basis, and to add alpha, whether the market's going up or down. So,
Terrific. Chris?
Hi, I'm Chris Patrano. I'm the Chief Investment Officer of Finemark National Bank and Trust. We are a bank with a national footprint. We're headquartered here in Florida with operations in South Carolina and Arizona. And we're managing about $3.7 billion in client assets today. Our loan portfolio is about $1.8 billion. We've been in business for nearly 12 years now. I joined the organization almost 3 years ago. And how we operate with clients on the investment side is really a bit of a hybrid model. We do manage some money in-house on both the large cap equity side and then a bit within fixed income. And then we have a fully sourced and vetted and diligenced platform of external managers, both on the traditional long-only side and on the hedge fund side as well. So the model is really, I'd say, quite akin to sort of a foundation or endowment or even a family office construct, which is not surprising because that's my background. That's where I spent the majority of my career, as did our head of due diligence, who's here as well, Najim Ghassem, sitting in the back. So that's really how we operate at FineMark. Thank you.
Terrific. And Tom?
Tom Krasner, Concise Capital. We're in Miami. Our firm specializes in a small part of the high yield market, smaller short duration issues. Short duration, we're running a portfolio of about 1.4 year duration right now, so it's turning into cash every year. And small issue size means about under 200 million, where most of the issues in high yield are 500 million, pushing $1 billion. We have $340 million under management. Part of that is in a hedge fund. We hedge by shorting the Russell 2000. The idea is to reduce the volatility of the long portfolio when there's a liquidity crisis or a flight to capital. We also run a UCITS fund, which is attractive to European investors. We're a sub-advisor to a liquid alternative, and we run some large separate accounts as well.
Yeah, terrific. Let's stay with you, Tom, if we would. Rates on the rise of late has no effect with what you do, correct?
No.
Okay. And that's because of the strategy, the hedging, the short duration aspect of it?
I'll give a longer answer. It has very little effect on our portfolio specifically because high yield, first as an asset class, is relatively little interest rate risk. Longer duration high yield is much more interest rate risk than we do. About 50% of our portfolio turns into cash every year. So what we could conceivably lose, which is very little, on rising interest rates, and we offset by investing that capital at much higher yields.
Okay, but to what extent do rates have come into the equation for you? I would imagine that if rates are on the rise, that as a comparison to other equity positions, or as Ali was mentioned a moment ago, about having short positions in general on the equity side of the equation, I would think that rising rates would be beneficial for your business in general, more assets under management coming your way because of concerns about, they're taking all the profits from Ali's short positions.
I wish they were, but the reality is rising rates have had relatively little effect. I mean, in credit in general, credit spreads are very tight historically, and people are very reluctant to invest in credit because they don't see the risk reward. That may or may not be accurate. I think a lot of the issues about equity tail risk suggest you shouldn't be in, if you're afraid to be in high yield, you shouldn't be in equities, you shouldn't be in a lot of assets. But I can't say that rising rates is having any material effect on us. In time, in the short, medium term, it's probably good because rising rates indicate growing economy. Growing economy is good for low default rates, and in high yield, it's all about avoiding defaults. Longer term, as interest rates rise, that means it's going to be much more expensive for companies to carry debt. One thing people don't focus on is the new tax policy, which means that only 30% of EBITDA is tax deductible. So that's going to have rising rates are going to have a punitive effect on more leveraged companies and hurt a lot of companies in high yield. But for us personally, I can't say there's a material effect.
Okay, no, understood. And then just last question for you, Tom. In regards to high yield in general, and you just mentioned default rates, that's like a really good indicator that many do not look at to see what the state of the economy is by looking at the default rates, assuming that you don't have, crazy corporate behavior going on, leveraging up or bad business practices, etc. Do you look at default rates to give you an indication of where the economy is, and where do default rates, if you do?
We follow default rates all the time because we receive the news on them and predictions on them from the credit agencies. Right now, default rates are about 2.5%, which is historically extremely low. Average default rates are about 4%. They'll peak in a recession around 12 to 15. The projections are that default rates are going to continue dropping through about April of next year. After that, it's hard to say. And for people who invest in stock markets, there's about an 85% correlation between rising stock markets and rising default rates. So if you believe that default rates are going to drop, stock markets should do okay in the short term. Afterwards, who knows? I mean, I bet we're in the late part of the credit cycle, but I've been wrong for 2 years. And one day I'll be right, but I have a broker who always tells me twice a day, broken clock's right. So we'll see.
Okay, well, your time may be coming soon. Okay. I want to get to some aspects of that with Ali in a little bit, but first I want to go to Garrett and talk a little bit about gold. You mentioned in your introductory comments about investing in gold companies, not the metal itself, okay? Can you divorce the two, one from the other? In other words, gold companies separated from gold itself. It's almost like saying, well, I want to invest in energy companies, I've got to look at the price of energy too, because that would be a key determining factor.
Yeah.
Thoughts?
On one hand, gold is it's a cyclical investment. You need to get your timing right, and then the miners on top of gold are like the original leverage ETFs, because they are pretty much solely dependent on a rising price of gold to generate value for their equity price. And as gold goes up, their profits will go up 2x, 3x, 5x, 10x, and they'll explode higher. If you look at the past, there's some interesting stuff. If you look at the total return S&P index from the end of 1999 to now, it's up about 200%. The price of gold over that time period is up 400%. That's surprising to a lot of people. Over the longer term, the S&P has performed much better. But gold does serve a place in people's portfolio. Like I said, the equities are, a leverage bet. A lot of the major names, I've been through a couple cycles. I've been doing this for 10 years. When I first started in the industry, it was kind of frightening what the majors in the industry were doing. They were trying to add ounces of production. They were trying to grow from 3 million to 4 million to 5 million. They weren't looking at underlying profitability. They weren't looking at free cash flow. They weren't looking at NAV in their projects. They weren't looking at IRR. It's frightening that you could run a business that way. They blew up. They've tightened up their balance sheets. Now they've got rid of unprofitable operations. Now they're looking at NAV. Now they're looking at IRR. They finally smartened up. A lot of the majors that you hear about, Newmont, Barrick, Hecla, companies like that, they trail. They'll trail going up, and they will lead going down. They're not able to get traction. Over that, the majority of gold stocks trail the GDX, and they trail gold because they got to pay management salaries. They're not doing smart things with investors' money, although they've gotten better. But there's a couple that have done well. One of them is Franco-Nevada. That's basically the biggest blue chip in the gold industry. It's a royalty company. And Randgold, that just got bought out by Barrick. Those two have outperformed the markets. The majority haven't. But where we are right now, as far as in the cycle. I presented here a couple of years ago, and it's been quiet. I think I get invited whenever it starts to get interesting for gold. If you look at the 1980s, there was inflation, interest rates went up. Right now, with interest rates going up, inflation hasn't really picked up yet. But one of the things that I look at closely personally is the commitment of traders. Commitment of traders measures futures positions. The managed money, which are hedge funds, has never been more short gold and silver since the data began in 2006. The last time this happened was in end of 2015, 2016. Gold went on a tear. The GDX went up 300%. So maybe we're in a situation like that right now. We'll see. And then ironically enough, if we are in a situation like that, the miners that are in the worst shape, that are most highly leveraged, they do the best. They go from verge of bankruptcy up 10x, 20x. So it's a matter of.
Okay, very good. So trail on the way up. Say Garrett, just a follow-up. Garrett with you. Trail on the way up and lead on the way down. It sounds like the investments that I make.
Yeah,
As a rule.
yeah. If you look at the big ones.
Let's say you're looking at the universe of gold miners.
Yep.
Gold, publicly traded gold mining companies, okay? Out of them, first of all, any general number as to what we're talking about, how many are there? 50, 20?
We cover.
Decent.
We cover 80. We cover 80 companies.
8 companies?
Yeah, 80.
80, zero.
Yeah, and they're all over 100 million market cap. A few of them are in tens of billions of dollars.
Okay.
The larger ones. And then in the whole, you got to go to Canada. It's very Canadian focused. All the major brokerages up in Canada, BMO. And Pi Financial, and there's a few others. Those guys focus on the mining industry, and there's a lot of smaller companies that are traded in Vancouver that are basically lottery tickets.
And out of the 80, how many would you say fall in the category of, looks good? The ones that you would...
20.
20 out of 80.
Yeah, and where we were in the cycle, like I said, the majors have been cutting back, trying to repair their balance sheets, and they've been neglecting exploration. So what you're seeing now is the balance sheets are better, but their production's dropping. So, and they don't want to spend money on exploration because they've been cutting back. So now they're looking into the market and they're acquiring all the smaller, basically explorer type plays. And the number one thing you want to look for in explorer is grade, because grade leads into low cost and it leads into profitability. If a project's got good grade, it has a very good chance of having a very good IRR and a NAV, and it's going to be attractive to a major because it's going to generate free cash flow.
And are they like end-to-end? Like when you think of energy, there's exploration, production, distribution, things, and a lot of stuff in the middle. You can break it down. With gold,
it stops at production. Explorer, developer, producer.
Produce?
Yeah.
Okay.
It ends at producer. Yeah.
Okay, at that point. And then in terms of, are the characteristics of a gold mining company transferable to other types of mining operations? In other words, like I want to now, okay, we've got the equipment, we've got the personnel, we've got the expertise.
Yeah.
Now we're going to, focus in on
not necessarily
palladium.
Because the geology plays a very important role. You have epithermal deposits, you've got high sulfide deposits, and the geological attributes of gold and precious metals and silver are much different than a nickel or a copper or a deposit like that. A lot of the mines in Mexico are narrow vein, epithermal. A lot of them are silver, gold, lead, zinc. So you've got real specialists in the industry that specialize in that sort of stuff.
Fascinating.
That
Great.
might not be attributed to nickel. Yeah.
All right, terrific. Thank you. Okay, Ali, Tom says, don't worry about it with the equity markets. Things, between now and the spring of next year, but you said in the beginning about big short position and all of that. Talk a bit about why you have such a large short position at this time. Is it particular issues or is it a macro call that you're making?
Sure. So most of what we do is from the bottoms up, but obviously you want to do a sanity check against, when you have this big of a short portfolio as we do now, you want to sanity check that against sort of macro issues. So to break it down from the bottoms up sense, there's only been one quarter in the history of the United States where you've had more companies in the Russell 3000 trading at 10 times sales. Now, 10 times sales is a pretty steep number. So if you exclude the real estate offerings, there was one quarter, ending in June of 2000 where we had 300 companies at over 10x sales. We had 271 companies at the end of this last quarter. And generally speaking, as you look at that list, it's pretty nasty. So I would say, that gives sort of a simplistic assessment of the bottoms-up nature of why there are so many great short opportunities. But I think from the top down, when you look at it, we're going to have a monster liquidity cliff that's going to hit next year that's going to be vicious. And I don't think anyone's ready for it. If you were to basically we're taking exposures off, right? So people give you money, you better have a good reason for it. So from the bottoms up, we feel good about it, but usually timing, I think, is harder. I don't think timing is so hard here, because if you were to look at, there are three sources. Stocks move up because of supply and demand. I mean, we could talk fundamentals all day, but in the end of the day, a stock moves up because someone wants to buy it, or it moves down because someone wants to sell it.
And on CNBC, they can give you the reasons why it went up and why the reasons it went down, and it's the same reason.
Yeah, so if you look at, there's three sources of demand. The sources are the people, the government, and the corporations. So if you look at the people, it's DPI times the savings rate. It'll give you the exact number, so disposable personal income times the savings rate. If you look at the government, it's the central bank balance sheet expansion, net expansion year over year. Then if you look at corporates, it's levered M&A and buybacks. So you can project all this. You can look at how much money came in the market. From 2008 till now, you've had an average of $1.5 trillion coming in the market a year. Next year, on a best case scenario, it goes to about 100 billion. And that doesn't consider the fact that you're blowing out deficits like you've never imagined, and all the other central banks in the world are also beginning their tapers. So we're going to have a massive liquidity cliff that we're hitting. That's going to make, where in this environment where you've had flows and you have everyone moving to ETFs, if you look at a bid-ask spread in the last trade, well, if the incremental buyer is just this blind ETF that buys, well, it buys up to the ask, and you get this beautiful upward sloping market. Now, when liquidity gets sucked out, the whole thing works in reverse. So between here and the end of next year, it's working in reverse, and it's working in reverse on top of a 10x, valuations that are at historical pretty much peaks. So I'm actually even bought some gold. It's funny. So if you look at the gold market, and if you look at GDXJ, which is the junior miners, so this is absolutely like leverage on leverage on leverage, and I just bought options on the GDXJ. So usually I don't do either of these, but it's funny because gold is the biggest short interest you can find right now, almost in history, pretty close. And then on top of that, if you were to look at the gold market, so crypto's been big for people, but if you look at the gold market, it's tiny. People don't appreciate it. So in aggregate, there's 30 billion in market cap in the junior gold miners. So Van Eck, that runs this GDXJ, has almost blown up the junior gold miner industry, and that's why I don't like the underlying, because the instrument could explode. But it could explode to either side, so the options are interesting. But if you look at it, Van Eck owns 15% of every single junior gold miner. So imagine what happens if you get a run-up in gold and people move to the miners. The thing is just going to go vertically ballistic. So I bought like a tiny, literally like a 5 basis point option position in this the past week. And if it goes up, like you said, I mean, it could be a 50-fold return. But we're pretty cautious.
Okay, and I want to bring Chris into this in a little bit, but stay with you, Ali. No, stay there, Ali. Just a couple of market-related and market-specific related issues. Shiller's Cape Index. You didn't mention that. It's at near record levels other than the dot-com period. Mm-hmm.
Yeah, I mean, valuations are a little crazy, generally speaking. And I think rates, another thing people don't appreciate is you've had a lot of things that have been positive for margin expansion. And when you look at labor costs, when you look at rates, when you look at taxes, these all take margins down. So I think one thing people don't appreciate, for example, in this rate rise that we may potentially have, 200 bips of rate rise is like 12 to 13% to S&P earnings. So imagine if you took S&P earnings down 12 to 13% next year, and on top of that, you took the demand destruction that comes with a 250 bip rate, 200 bip rate move, and the market's getting cut in half. I mean, I'm saying 40%. So I think the market's down 20 to 40% in the next
I think that
18
qualifies
months.
as a bear market then, under those things. Okay, just state it.
All right.
Okay, another issue is, in spite of the things that you're mentioning, the U.S. market continues to march up, okay? Not far, we had a little bit of a pullback recently, but it's had pullbacks before, okay? But compared to other markets, you have this glaring divergence between the U.S. market, large, mid, small cap, doesn't matter, and everywhere else, ROW, rest of world, okay? Concerns? That part of your...
Well, I think the problem...
That's a macro question, I understand.
Yeah. So I think the problem that happens is the U.S. has done better, so the U.S. deserves to do well. But the other problem is you've had a massive flight to safety trade. And so when you look at all these others, the average rest of the world is down like 23% this year versus the U.S. being basically flat. And I think where you're going to have an issue is as soon as they get at all stabilized, the money's just flooding out of the U.S. So, while we're on this performance peak with nice multiples, all the money's come to us too. Well, then you slow down the performance, the rest of the world picks up a little bit, and then the money all leaves. Mm-hmm. So it's a bit of a, we're at the best point kind of the cycle where we're doing good and it's scary, so everyone flooded over here. And then you look at some of the trade situation. I mean, small caps had a good run and it doesn't make any sense, but the knee-jerk reaction has been to just allocate to small caps because they don't have international exposure. So I think even in those areas, you're going to have some real issues. I think EV to sales of the median company in the S&P 500 in 1999, the median S&P 500 company was 1.15 times sales, or around 1.15, 1.2 times sales. The median S&P 500 company right now is at 2.15 times sales. So we're in a whole different world. And what's supported us is these big FANG stocks that are a lot higher quality than they were back in 99. Right, so you have Apple that's had a great run. It's peaking out, but it's had a great run. It makes enormous profitability. You have Facebook, enormous profitability. Google, enormous profitability. Right, so some of these, Microsoft, so some of these big behemoths have kept the show going. But I think those behemoths themselves have problems. So I think that, there's a lot of near-term risks.
Okay, very good. Chris, one of the elements that doesn't seem to be a characteristic, there's this divergence between U.S. and the rest of the world, but one of the things within the U.S. market, the equity market, there doesn't seem to be a narrowing of leadership, at least not yet. The general's moving out, the infantry doesn't follow, that type of thing, which is a divergence unto itself. Okay, do you look at indicators like that in your decision making? Again, this is a macro strategy type of question, top down.
Yeah, we definitely look at leadership within the index, and what Ali was talking about insofar as valuation is definitely something we've been concerned about. The issue with valuation is it matters a lot, only sometimes. So what I mean by that is until you get to a really very wide divergence from the norm, you can stay there for a very prolonged period of time. And so insofar as making asset allocation decisions, while valuation matters, there are other factors that are more important to us from a timing mechanism standpoint. So some of those factors are technical, and specifically things such as profitability, margins, growth rate of sales. And Ali spent a lot of time talking about the late 90s, which when I got into this business, it's, I don't know, for some reason, very fresh in my head. And one of the things that we've looked at is the massive divergence that you've seen in value versus growth. And so to his point about these very significant overvaluations of certain segments of the market, you've seen this manifest both in the long-only world, but since this is a hedge fund panel, maybe we should talk more specifically about that. Most hedge funds, specifically if we're talking about long-short hedge funds, are going to have a natural value bias to them, at least on the long side of the portfolio. And so this has hurt them on both sides. This has hurt them both on the short side because the most overvalued stocks have become more dear. So think about, the Facebooks of the world, the Amazons of the world, the Teslas of the world, and the cheaper value stocks, which would generally constitute their long book, have sort of languished or lagged as compared to the broader market. So these are factors that we look at, and from our viewpoint, something that we've not seen such a big divergence for in at least 20 years. In terms of U.S. versus international, we would also agree that the pendulum is likely to swing back to international at some point. In terms of international, the market that looks most interesting to us is Japan. From a valuation standpoint, the funny bit about Japan is it's looked cheap for a really long time, but it does look cheap again.
Okay. Go back to the point that you just made a moment ago about hedge funds, long, short, doing the value bet on the long side, and then going short. It seems to me it's not like doubling the position, but it seems by default value tends to be less risky. So why would you not, in a balanced mix, have growth and short rather than value and short? Because under those circumstances, value and short, there's a tilt. The tilt is to the downside. The value is trailing. Okay, it's not outperforming in this environment, hasn't been for quite some time. Growth has been outperforming. Why would they do that? I mean,
I think you make a really good point on the long side, but longs and shorts, and the only long short manager on this panel is Ali, so he probably could talk about this more intelligently than I could, but I'll answer your question. The major difference is on the short side, your path is like critical. It's so important, and it's the thing that people miss the most. And what I mean by that is, if you're long a stock and you buy a stock for, pick a number, $10 a share, and it ends up going to $2 a share and ultimately $30, provided you held it, you're fine. And as it went from 10 to 2, that position got smaller for you. In other words, it became less consequential on the way down. On the short side, the arithmetic works in the exact opposite way. And so, and in addition to that, you're paying to borrow the stock. So the longer you maintain that position, the more it's costing you in your short margin rebate to stay short. And so you can have these very wild situations. The one that comes to mind to me most recently was this crazy Tesla situation where the CEO of the company gets out and talks about him taking the company private at a massive premium to where the stock was trading. If I remember right, it was like a 35% premium.
Was that when he was smoking the weed?
Yeah, exactly. And it was, so I guess, a sort of ode to his girlfriend, who apparently enjoys smoking marijuana as well. Right. But that the stock were going to be taken private at $420 a share when it was trading for, I want to say it was about $330, $340 at that point. You could ultimately be right if you were a short seller, but an event like that can completely take you out of the stock. And so that's the difference when you think about value. You have that exposure on both the long side and the short side, but on the short side, timing is so much more critical because of this path dependency.
Understood. Ali, value, long, short, your positions without opening the kimono too much. If you can give us some sense of where you're at on the long side of some of the positions, do they fall in value or growth? And in the short end, the time period that Chris is talking about, does that resonate
I
with
mean,
you?
we're very value biased. I think that what people need to do on the shorts, I think where people have failed on the short side is they don't recognize that, there's a reason that people may like a stock, and not everyone has to agree with you. And if they like the stock and they want to continue liking it, they're not going to sell it, and it's not going down, so you're going to get beat up really badly. Right. I think, like, for example, a company like this is Netflix. Right, there's all these value managers that are out there talking free cash flow, free cash flow, free cash flow, and all they talk about is free cash flow. And then on the Netflix release, all they care about is subscriber net ads. If they put nothing in that release except the subscriber net ads and just said, we won't tell you the rest, the stock would have been up 10%. So if you can't recognize that the people that are on the other side of the trade don't care what you're talking about, right, it's not going to work. And I think where a lot of the value managers have problems is that they've been contrarian, because if you go buy something that perhaps has a big, like a 25% IRR, you go buy it and there's 7 billion people in the world that want to make a lot of money, and they'll come buy it, right? Whether it be their manager or someone's coming in there, and you're going to get paid. So they take that same mindset and they try to apply it to the shorts world. So they go out there and short something because they say to themselves they're convinced it's crazy. And it turns out that the people that own it don't think so, right? So for example, in Netflix, they just believe they keep adding subscribers and their marginal content cost drops below what anyone else's could possibly ever be. And so they'll win, right? So that's where the real issue is. In the short world, you're not going to get enough short sellers to come in to short a stock to drive it to realizable value, because there's only 10% of the float that max can short, right? So if you can't reconcile why someone who owns it doesn't want to own it anymore, and when that inflection is going to be, you're going to get trashed on the short side shorting growth stocks. I think generally it's this mental inability to kind of step outside your own box, right? That whole contrarianism that makes someone a good value investor, you just got to shut it off. Almost when you go to the short side, you've got to understand your perspective, but you need to understand their perspective at least as well as your perspective, because you're only getting paid when they change their mind and say, "Oh, you were right," right? You're not getting paid just because they got, they got other people came in and realized it.
Understood. I'm going to ask 2 more questions to the entire panel, and then we're going to go to questions from all of you. So please think about the questions that you would like to ask. I'm coming to the end of my segment, other than being the master pointer of who's asking the questions from the audience. We talked a lot about challenging issues for all of the markets, particularly the equity markets. One of the things, and this is going to tie into something else with alternative investments, one of the things that is a positive, if you look at the alternative investment space, and I would imagine this is a positive in general for investing, and that is dry powder. There's a lot of capital that's sitting out there. If you just look at it from the point of view of hedge funds and private equity and the trillions of dollars that sits there, and it's dry powder and it's committed money and it's going to go, and that whole dynamic of the alternative investment space impact on the publicly traded market, I would think that that has to be a dynamic that's there, that's driving equity prices, and for a while, the bond market in a positive way. Any thoughts on that dynamic of the dry powder, the alternative investment space, the money that sits there, its impact upon, in general, issues that are publicly traded and privately held, the whole valuation dynamic that's there? Any thoughts on that? It's a broad stroke, open-ended question, and if you all give me a blank stare, that's okay too. Yeah, please.
I mean, I think it's a big market, right? We have a $28 trillion market. So if you look at some of these, it's still a little small in this grand scheme of things. And if you look at $1.5 trillion of liquidity injected every year, I think even if you look at these massive private equity funds that have been raised, it's not that massive compared to that. But at this point, they do have a lot of dry powder. They have to put the money to work. Rates are low, and so they are providing a bit of a bid under it. And I think people have forgotten to some extent that you make a long-term commitment. I don't think people appreciate these long tails on the commitments that they're making to some of these alternatives, perhaps. Right? I remember in 2010, people were freaking out because they still had a commitment that they had to give someone, and then now, it's not as much of an issue. But I think it has an impact. It's driven multiples a little bit, especially with rates being low, but I don't think it's enough to offset.
Well, do you think that it has some kind of an impact in the sense of it moving the needle because of the fact that it's at the margin?
Yeah, I think it's definitely at the margin, right? We're seeing I think private equity multiples are like 11 times EBITDA, right? So they're paying up and they're buying stuff. But I think that it's smaller than. I think the problem is when you go all ETFs, what happens is you destroy the small cap market. So when there's not as much small cap issuance, and when small cap companies just decide that they don't want to be in the market, right? The market doesn't support them anymore. You used to have 5,000 companies in the market. So now you have 4,000. Well, 1,000 of them just basically shifted to the private market. It didn't so much change the dynamic from the capital standpoint as much as it just shifted it from the public market to the private market,
Okay.
in my opinion, a little bit.
Anybody else have any other thoughts? Okay, then to interject a question here about ETFs. Anybody concerned about ETFs? The impact they have on your sector and fixed income and the equity markets, gold markets. Anybody have any thoughts on that? Ali, you've got it.
I mean, I think that if you look at the small cap, the ETFs are only work in the big indexes, right? So buy an S&P 500 ETF. It's wonderful. It's tax efficient. At Fidelity, it's free, right? But if you step away from that, it's a disaster. If you look at the Russell 2000 and the S&P 600, if you're in both of those, it's over 40% of your shares outstanding. So think of this in these small cap companies. 40% of your shares outstanding are held by 2 ETFs. Management holds 10 or 15%. And then in that interim period, in that period group in the between, it's 25%. Well, that 25% is 2 or 3 active managers at 3 or 4% positions and a bunch of irrelevant stuff. Well, guess what happens when one of those active managers goes to sell, right? There's no underlying liquidity in the market. So the ETFs have destroyed the small cap market, which is going to make it really vicious on small cap side. But it's going to be amazing for creating opportunities, right? So I think it's going to set up very well for active managers. You can have a disaster in small cap ETFs, and then you look at the GDXJ, it's a broken instrument. It's a good thing to look at and just study and get a sense of what happens when an ETF gets too big for its underlying index. So I think they have a lot of issues. I think the big cap stuff is great. Right? Mm-hmm. Buy a big cap ETF. But I think when you move away from that, be very, very, very careful.
Okay. Anybody have any? Please, Tom.
Almost all of the growth in ETFs has occurred since the financial crisis. So none of us really know what's going to happen when the bottom falls out. Some people who've studied ETFs tell you they'll work out fine. A lot of people have misgivings. We follow an ETF as our benchmark, the HYS. I can tell you it's more volatile than the high yield market as a whole. It's more volatile. It's more affected by supply and demand. And Ali could be completely right that watch out once there's a liquidity crisis, but we just won't know until that occurs. And a lot of the things we've tried with moving away from active management, moving to ETFs, moving to really just passively investing, they are experiments. And we've had the luxury of being in the biggest bull market in history, and at some time it's going to end. And it may not end well.
Garrett, do you have any thoughts on gold miner ETF?
I totally agree with Ali. The Van Eck, they have the GDX and the GDXJ, and the GDX is for the larger miners. The GDXJ is the smaller miners. They have miners in there that have market caps of $30 million, $50 million. So you have money pouring in the GDXJ. It has to buy these small miners. It causes chaos. And whenever they do a rebalance, you have to be extremely aware of what's going on, because sometimes they get moved from the GDX to the GDXJ. The percentages vary. But as Ali said, also it creates opportunities, because if you know what's going on regarding the fundamentals of these companies, and you see these technical factors affecting the stock prices to create a value situation, it's an opportunity. But when the gold market is volatile, so the money is going to be pouring into the GDX and the GDXJ, and it takes the sector up and it takes it right back down again via the ETF. So yeah.
Okay, and then my last question, and the questions from all of you, and I would ordinarily think that this question, I would be concerned about raising this point, but I can count on Ali answering this, because he's kind of alluded to this in different ways. And it's a little segment. When I wrote a book way back when, I called it Keeping My House in Greenwich, okay, which is a subtle way of talking about behavioral finance, Greenwich, Connecticut being a high-end area, a lot of hedge fund managers there and private equity. How much of the market dynamic, and Ollie's kind of alluded to this about, well, buyers that are there and volume and all of that stuff. How much in your decision-making do you put into the equation of the behavioral finance aspects of investment decision-making, specifically things dealing with regret, which is not supposed to be in the efficient market hypothesis? It's not there. These elements are not there, but anybody who's been around the block for a while knows that if I'm competing against Tom, okay, I'm thinking about what Tom's doing, Tom's thinking about what I'm doing, and that is a factor in my decision making. It should not be. It should not be, but real world, people jobs, you don't want to be the outlier. What's the Japanese expression? The blade of grass that rises up the highest gets cut off. The nail that sticks out gets hammered down, those kind of things. Talk about that. Does any of that come into your decision making? Drum roll.
I just, so I focus on gold specialists. Gold is an extremely emotional metal. You mentioned gold, people have a strong opinion. Either they love it or they hate it. There's no in between. You mentioned nickel, you mentioned copper. People are like, but you mentioned gold. It's extremely emotional, tied to, the financial system. It's where people go in times of stress when they need safety. So emotionally, you can look at gold that way.
Okay. Anyone else? Any thoughts?
When we talk about behavioral economics, it's pretty hard for me to figure out what Vinny's going to do. I don't worry too much about that. But where it does come into play a lot is in knowing yourself. We have a situation where we had a default in August. And one of the things we were asking ourselves was, were we psychologically too bound up in avoiding a loss, in recognizing a loss? And I think where you really can get behavioral benefit from behavioral economics is it's good to try to judge the market, try to judge what other people are thinking, but it really comes into play in knowing your own motivations and in knowing when you're being affected by emotions and making decisions rationally versus emotionally, and trying to find that right line. To go back to your question on the effect of capital, just there being too much capital right there, and how that's affecting the markets. We all see it around us. There's just a tremendous amount of capital out there waiting to be allocated. It's huge valuations in the equity market, record or near record credit spreads in high yield, an 82-story building being completed next door to me in Miami. Just too much money out there. And it's going to run until people get scared, until something changes. We don't know when things are going to change and what that catalyst is, because by definition, things are unknowable. And the catalyst you can't see until it comes. But something's going to end this, and that's the time things are going to change. If we look at just behavioral finance and predictability, I like to remember just before oil went to $20 a barrel. Was it, I think, late 2015, early 2016? We were following the forecasts, and after oil went to 20, I was looking at one firm which published the predictions of about, I think, the 25 leading oil forecasts. It was at 100. The worst forecast from 100 for the following year was 85. Nobody saw it going to 20. Nobody's going to see this bull market end or know when it's going to end. But at some point it will. At some point, the too much capital is going to change into fear, and money being kept in treasuries and cash in safe assets, and then people will be scared to invest when it's right, because we've all seen it before, and we know the music's going to play the same way. We just don't know when.
And Concise Capital's AUM goes up?
We'll see. We'll see.
Okay, yeah, Chris?
One of the things that we pay careful attention to, and I don't know if this makes us really unique or not, I'm not quite sure about that, but we really focus heavily on flows into ETFs and into mutual funds, and we break it out by asset class. We study this at least monthly, if not more frequently. And one of the things that has continued to give us a rather large degree of confidence in continued outperformance of equities is the very minimal participation that retail investors, as measured by ETF and mutual fund flows, have had in this bull market from the bottom. And to put that into perspective, they still actually have had fund flows out of equities and into fixed income instruments. And as sort of sad as it might seem, retail investors are really good at doing the wrong thing on both the top and the bottom, and make for a wonderful indicator. It's easier when I can make these conversations in front of an audience like this versus potential clients of our bank. They sometimes will get insulted when we tell them we look at retail investors as sort of easy marks. But this is something that we've done. So I don't know if it's a behavioral finance thing, but it's something that we look at insofar as where we would believe dumb money would make mistakes.
Mm-hmm. Okay. And Ali, you have any thoughts?
I just have a book recommendation, which is Thinking Fast, Thinking Slow by Kahneman. It's like brilliant. It's really will change the entire way you think about everything you do in your life, and it's all built up. I mean, he won the Nobel Prize for behavioral economics. It's really, 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 really good.
Yeah, excellent. And by the way, just a little addendum to this. A number of years ago in Aspen, Colorado, I was at an event with the money manager, David Dreeman. I don't know how many of you remember that name. And he had created this Institute for Behavioral Psychology. And he was, and this was before Kahneman and Tversky, and well, Tversky didn't get it, but Kahneman and Vernon Smith, I think it was, received the Nobel Prize. And Werner de Bond, who was one of the leading thinkers in the behavioral finance, behavioral economics, behavioral science field, I asked him a question. When do you think behavioral finance is going to be incorporated into valuation models? And he said at the earliest 10 years, and that was in 2000. And it still hasn't happened. So if it's not quantifiable, it's not in there. But everybody knows this is the way the game is played. It's just how do you quantify that and exploit that as an investor? Not a real easy thing to do. So this was great. We covered a lot of ground. We have time here, a fairly sizable amount of time to go over questions. So please, why don't we go here and then there? Yes, sir.
What is your take on the Barrick and Reingold marriage?
Mark Bristow, the CEO of Reingold, that was one of the top performers of any gold stock over the past 10 years. He did an amazing job. They had the Gabali mine, and he worked in basically Africa, the DRC, the Democratic Republic of Congo, Mali, some really tough areas. He made basically all the workers there stakeholders, and he really brought the community, and that's why he's been so successful. That's getting a tougher place to do business because, as the government see that the mines are profitable, they come in, they want more. It's a very tough place to do business. And then John Thornton, the CEO of Barrick, he's a Goldman Sachs guy, so he's not a miner. So, he cares about free cash flow and financial measures like that. So Bristow's coming in and he's going to take over Barrick, and his CFO, Mark Shuttleworth, who's going to be running the numbers behind them. It's kind of like apples and oranges. Like, Bristow does a great job, but I don't see the synergies between, heap leaches in Nevada and, deep, vein mines in DRC. But that's the sort of things you see at, market bottoms, big consolidation within the industry and mergers amongst equals.
Yeah, excellent. Question over there. Yes, sir.
So, Ali, I thought it was a very decisive comment about the need for a short to understand what would change a long opinion. on a stock. And it reminded me a little bit of a book Ned Davis wrote a long time ago about it's not being right, it's about making money. And it also reminded me of a phrase that the difference between salad and garbage is timing. To what extent do you use technical indicators? If you do, which indicators do you use? And Chris, I think you also said you use technical indicators.
I generally don't use too many technical indicators. I mean, I'll look at relative strength just to, pay attention to things more, but that's very, very sort of simple stuff. Most of the time, it's trying to understand what the catalyst from a fundamental standpoint is, really understand what is it that other people are looking for so that when that isn't there, you can act. So much more from a fundamental level.
I'm going to add one more thing to that, and tied to the discussion before regarding psychology. Obviously, there's some really smart quant funds that are popping up across many industries, whether it's equity or fixed income or crypto. And some of the ones right now, one of the successful things is they're measuring investor sentiment by tapping into the Twitter feed and doing some neuro-linguistic stuff in order to measure sentiment. When it gets too frothy, you want to get short, and vice versa. And that's a way that's interesting that you can quantify sentiment with if you're good at that. Yeah.
Chris?
Jim, just to answer your question on the technical indicators, it's largely moving averages and varying time frames, but not in isolation. In other words, we marry those with margins in terms of making asset allocation decisions.
Using a moving average, what time frame do you use for your moving average?
Well, generally 200 days is something we really look pretty carefully at.
Wow, we've answered everybody's questions. Yes, sir. Please.
The corporate buybacks have been a lot of inflows there. It's kind of supports up there. I don't know if they're exactly, but they're pretty high. We just had the peak blackout period, and that's kind of coincided with this most recent downturn we had. What do you guys think that continues? At what point do you think the corporate buybacks kind of run out? Is there a certain, as interest rates go up, leverage is harder to put on, so you have to kind of bring that down?
The impact of corporate buybacks in general on markets.
They buy at the top, they'll sell at the bottom. I mean, if you look at the history of S&P, basically shares outstanding in the S&P went up by 8 or 9% in 08 and 09, and they just recently returned to where they were in 07. Now, by the end of this year, they'll be like 2% lower than that. I think as you walk into next year, that'll all end. This was a big repatriation holiday. If you look at you look at Apple, they can't buy back $25 billion worth of stock a quarter. They don't have the money. They don't have the cash flows. You look at from Cisco's to Oracle's. These are just monster cash piles that were sitting overseas that they couldn't do anything with, and then they got the green light, and the only thing they could think of is buying back stock. So I think that we're at $1 trillion this year. It's at an all-time high. If you were to look at the chart, it goes up to 07 and then it just dies. And so I think we're back up past 07, and I don't anticipate it will continue.
Okay. All right, and let me follow up with one or two questions while everyone sort of thinks about. And you do have your dessert there. Did they serve the coffee? Maybe if we got the coffee going, we'll get some more questions along with the dessert. But let me ask both you, Chris and Ali, in regards to fund flows. Do you look at fund flows as a dynamic? I think that you had said earlier, Ali, that you do in terms of your investment decision making. Yes.
Yeah, we do. We definitely do. And we look at it really from not investing in individual funds. We use it. It sort of drives part of our decisions around asset allocation. So, like for example, most recently when we looked at it last month, major outflows out of Europe. And as I said earlier, the big statistic that we've constantly maintained is lack of retail participation in this equity bull market that began in 2009. So we use it both on the fixed income side and on the equity side, and think it's very meaningful.
Okay, understood. Ali?
I look at overall market flows. I think I do see what Chris is saying in the sense that you haven't had flows in, but you do have a higher percent of people's net worth in the underlying equities than a lot of times in history. So it's a tough thing to kind of figure out. Are they going into equities or what? But you do know that money is coming into the market, and when it goes into the market, the equities are the tail of the whip. So, I don't have as much good granular data, but I just kind of keep an eye on money's coming in, it's going to drive demand, whether that means it pushes rates lower and then it pushes multiples up or not. It all kind of works the same way, and the equities are the tail of the whip.
Mm-hmm. Understood. Okay, here we go. Yes.
So I will ask that frequently people obviously invest their clients one way and invest themselves slightly more esoterically. So usually I love to ask people what their small bets are that they're hoping they're going to, and Garrett kind of shared the GDXJ or the RAM, but then the professional recommendations. But what are you investing in personally that you're hoping really takes off? I think Allie's probably the most esoteric out there, but I will give you Tom.
Most of my liquid net worth is invested in the hedge fund, which makes my clients happy. And when I go visit them, they ask me, "How much are you? Where are you invested? And how much are you guys invested?" And I, tell them it's pretty much all invested in the fund, except for the house I own and a few things. Outside of that, and I'm talking about very small amounts, it's actually sitting mostly in cash right now, just because I'm concerned about really the things Ali alluded to in the medium term.
Well, that raises a really good question in regards to skin in the game. Don't you find that you'd like to be invest with a company where management or there is skin in the game?
Yeah. I'll also I'll answer that, but I want to go on just two different issues, sort of preceding questions. One is, where are institutional investors in the hedge fund world looking to invest? And Chris can comment on this probably better than I can. But a lot of what I hear from allocators is people are concerned about valuations, and so they're looking in non-correlated assets. And so that speaks well for money going into long-short equity. But there's been a huge boom in private debt, and a great deal of funds going into things that are very esoteric. Private asset-backed deals, litigation settlements, all kinds of strange things, just because people are looking for protection when the market does turn south. And so that's one thing to be aware of, and how a lot of professional asset allocators are looking. It also makes it a bit hard to rate assets in high yield. I was going to talk on fixed income flows. Chris and I were laughing about that in credit, in high yield, fixed income flows have been hugely negative since 2017, and they've started and into 2018. In the summer, they started to level off and be flat. Now they're we're seeing outflows again. But where's the money? Well, a lot of the money is going into investment grade. So if you're interested in thinking about your fixed income allocation, I think investment grade is attracting money, and probably will continue to do so, especially if Ali's correct. Then to answer your question, we go out and we visit companies, and we like to see how management's compensated, who owns it, and all of those issues are critically important in the decision, because as Vinny said early on, you have to get the due diligence right early, and you have to make sure that what you buy, there's an alignment of interests.
Yeah, in terms of my own portfolio and how it would differ from most of our clients, first I'd say I think I finally recognized that I should stop running my own portfolio and basically have moved away from doing that and have given all my money to our managers. So I really don't have much of a PA of individual equities anymore, and I think it's a lot smarter. It's sort of like the shoemaker's children have no shoes. In terms of allocation, the big difference between me and most of our clients is age. So I have virtually no exposure to fixed income, and probably a lot, I would say a lot more exposure to alternatives, and specifically today, trend following CTA systems, both short-term sort of neural networks, longer-term systems, just in anticipation that if this market were to roll over, those are likely, at least in my view, to be things that could really become very negatively correlated very quickly. And right now actually tend to be somewhat positively correlated because they're long equities given the long equity trend that we've been in. So that correlation benefit would unlikely kick in right away, but if we have, a real bear market manifest and not just sort of a 1 or 2 week blip on the radar screen like we seemingly have gotten this time or in the first quarter, it's something that really could help protect capital. So that's the difference between me and our clients.
That raises a really terrific point about a future program here, a part of alternative investments, which is neural nets and other CTA, those kind of approaches and investment opportunities in the alternative investment space. I don't think we've ever covered that in the 15, 16 years. I think that would be something maybe we'd put a little bit of effort into for next year. Okay. Okay, I can ask another question. Okay, here we go. Yeah.
Chris, primarily for you, asset allocation, portfolio construction type of question. What's the universe of alternatives that FineMark looks at, and how do you go about making those decisions between the different flavors, whether it's hedge fund, private equity, real assets?
So today for us, and this is by no means exhaustive, but today for us at FineMark, the three major areas for alternatives are long-short, sort of macro CTA, and then multi-strategy. Our exposure to privates thus far has been very limited, not because there isn't demand for it, largely because prior to my joining the organization, there was no internal research effort there, and so there was really no method to have access to these types of strategies. But our goal for 2019 is to begin to onboard more private opportunities, be it in real estate or equity or other illiquids. We view these as potential alpha areas insofar as the idea of trading liquidity for returns, but also recognize that some of what's sold to investors out there is really malarkey. What I mean by that is they hang their hat on correlations, and the correlations really don't exist because you don't have pricing, and therefore you can't properly do this. And I thankfully can explain this in front of an audience of CFA charter holders who get that sort of stuff. But the industry is rife with folks that try to sell this stuff as non-correlated, and I would argue actually a lot of it's very, very correlated to equities. If the equity market is in a bear market phase, you're not going to be able to have an IPO exit for your private. So you're basically, in it to win it with these guys. I do think that there are other illiquid opportunities that you can take, and there is an economic rent to be had there for giving up some of your liquidity. But to date, we've not done much of it.
Okay. Yes, sir.
Kind of for Chris, you talked about monitoring ETF flows and then selling it to retail investors. Can you explain that? Just a little bit better. What are you actually doing there?
Sure. So we have a number of third-party research tools that we subscribe to. These are sort of for subscription services, and track flows both within the mutual fund world and within the ETF world, and have that broken down by asset class. So within the equity world here in the U.S., developed markets, EM broadly, and then within fixed income, breaking it up between the high yield world and investment grade. Really, that's as deep as we go with it. We don't go into really individual country flows within EM or DM. We basically break the world up that way and separate the U.S. out. We also do look at flows within large, mid, and small inside the U.S.
One of along the lines of what Ali had said earlier, in regards to Apple and having the cash and, what are they doing? They're buying back their stock. Is part of the dynamic, and does anybody have any concern about this, if this is so, that there just aren't enough good rates of return opportunities that are out there? You got a lot of liquidity on the corporate side. Where's that money going? It's going into financial, instruments, things of that sort, but it's not going into companies and, growth opportunities. Yes.
Yeah, I mean, people aren't spending any money on R&D anymore. If you look at it, it's all a big financial engineering scheme. So if you look at the big pharma companies, for example, pharma companies, if you look at their R&D levels, they're as low as they've ever been. They've basically taken the MO that why don't we just not spend money on R&D because we get a big multiple on earnings and R&D hurts earnings, and instead we'll go buy companies that spend a ton of money on R&D. So it's basically sort of this backdoor way of spending R&D and driving your multiple to look like it's less because you don't have that expense running through the P&L. Right? The traditional way to do it would have been to go just develop the drug yourself. Don't wait for someone to go do it and then go pay $20 billion for it. Right. So I think that there's financial engineering that's going on, right? There's a little bit of gaming that's going on. And I think companies like Apple, I mean, they just have so much cash, right? They hit a moment in time. They made a product like they make the Mac back in the day, right? So this is number 2. This is lightning in a bottle number 2 for Apple. They made the Mac. They got up to 18% market share. They had a closed system. Everyone in their, all the PC-based guys came in and crushed them. And now we're, in inning 7 of the iPhone setup, right? Apple's now about to become the 4th biggest cell phone manufacturer in the world. Their unit sales are down. There's 6 billion cell phones floating around the world, and they don't have anything else. So they got to buy back a ton of stock. But it's just this lack of running it through the R&D line, right? It's a lack of spending because they know the market rewards, multiples on earnings. And, well, if you spend on R&D, you don't earn money. So just borrow money and go buy what you want.
Tom?
Yeah, we see a lot of plays in the oil patch being in high yield. And, one of the fascinating things about oil and fracking is that fracking companies don't make any money. So we've become, I think the world's largest exporter of oil. But the cash flow isn't there. These wells get drilled. They have much faster production curves than normal wells, which means you have to spend a ton of money to get to the oil. You get good production for a year or 2 years, and then it starts to peter out. And if you look at free cash flow, you really wonder how sustainable this cycle is. And you easily could see another catalyst here being that the easy money, which is financing all this development in the oil space, isn't there, and that could cause a lot of duress in oil companies, especially as those companies need to make the financial payments that finance the capital expenditures to get them to the production levels.
And as part of my role, I'm the CIO of the bank, but I also sit on our board, and we're a real bank doing lending all day, every day to both individuals and commercial entities. And what I'll say is there's definitely a slowdown occurring in lending. Specifically, we're seeing loan paydowns. This began last year, and it accelerated into the year, and we've seen it all year this year. As spreads have compressed, traditional spread lending models like ours and other banks become more compromised as you're paying your depositors more, and it's harder to find loan demand. So this is real. Another indicator that I would look at, and I'm actually surprised that it's moved so far so fast, have been the home builders. If anyone's not paid attention, these guys have been absolutely crucified this year. And it's been obviously a good year to own equities, and these guys have been just tattooed. So as someone that, sits on the front line and sees what mom and pop businesses are doing all day, every day, I'll tell you that they're borrowing less money than they were. They're paying back money at faster rates. Defaults don't exist thus far, at least in our world. We've not seen defaults on loans. Property prices have held in. But those that we're using, and I'm talking about high net worth and mega wealthy individuals that were using their own balance sheet, are doing less of that than they once were as a result of the tick up in rates.
Okay. A question in regards to alternative investments and a motivating factor for organizations like CalPERS and others to invest in the alternative space. One of them being you're not dealing with mark-to-market. So because you're not dealing with mark-to-market, you're not dealing with pricing, and so if you have a required asset liability match going on in the case of a pension fund, if you don't have to mark-to-market, okay, isn't that an incentive to go into the alternative investment space? Anyone have any thoughts on that? It's either that or I'll do the Kirk Cousins touchdown dance. It's not that, because we got to do 2 hours, right? So I can do Kirk Cousins.
I mean, I think they feel like it's okay because the last cycle they were bailed out so fast, so they never had the mark on those instruments, right? So if you go to, if the market gets trashed and it bounces back because you're going to go buy, trillions of dollars worth of bonds and bail everything out, well, then don't worry about mark to market. But in the reality is these cycles usually go a little longer. You're going to have to market, and it's going to scare the hell out of people when you market to market. So I think this is just this sort of figment of people's imagination that there's no marking to market. You didn't just make a loss disappear because you didn't want to talk about it,
But
right?
if I'm a pension fund and I'm hypothetically CalPERS, and I have 20% of my portfolio in alternatives that are not mark-to-market, okay?
Mm-hmm.
I can list down the values based upon what? Private valuations, or, although, in other words, it's not specific to the investments. I mean, I'm not saying anything nefarious here, okay? But it just seems to me that it would be something that would be helpful to pensions.
To not have to mark. I think it's helpful to the career of the allocator that put the money in there because they can't get fired in 6 months, and when it hits the fan, they're going to go get a new job before it has to be mark to market. So it's a wonderful career management behavioral
Well, it's kicking
tool,
the can down the road.
right? It's beautiful, right? You don't have to know what I have in my book because I don't have to tell you, but I know what's in there, and when it gets nasty, I will leave. And you could take care of my problems, right? But in the end of the day, other than that, it does nothing. So I personally think it's unethical, right? I think the reality is you
But
are marking every day.
Unethical is not illegal.
Well,
Okay.
I mean, I don't think it's going to play out well for people that are doing it for those reasons. I understand that private equity's driven nice returns for people. I understand that small caps have disappeared to some extent. I understand these big pension funds need to access that side of the market, right? So if they're doing it because of that, it's a reasonable, fair way to do it. But if they're doing it just for mark-to-market reasons, then they're people that you shouldn't go near, as far as I'm concerned.
Yes, Chris.
Well, this is what I was trying to allude to before. In other words, the reason to invest in privates isn't because you can hide your losses in some sort of accounting gimmickry. That's crap. The reason why you should invest in privates is because there's some sort of mispricing there that you can take advantage of, and this is what I was talking about when I said if you could trade some of your liquidity, if you didn't need all of your liquidity and could capture that in the form of higher returns, then that makes a lot of sense. But to do what you're describing is this sort of classic agency risk problem, and Ali's mentioning this too. There's a lot of bums that sit in these asset allocator seats, and they see the value in the seat. This is no different than in the long-only world where you had people saying things like, oh, well, you can't get fired for owning Philip Morris or IBM or GE, and guess what? You can, and you should. And they should carry these bums out because they give the industry a bad name. And it's really, I think, the difference when you're looking at managers and trying to understand the difference between people that are truly active and are just benchmark huggers. This is exactly it. This is exactly, if you had to learn anything about this business, this is exactly it. This agency risk garbage that goes on that people use to keep a job, a high-paying job, and be able to hide in it.
Oh, yes, sir, please. Oh, here it is. Juan Valdez did show up.
From Florida, there's just been a really extraordinary building, no matter where you go. Is this characteristic of the rest of the country? And if we're going to get less money pumped into the economy, would this be a vulnerable point?
Anyone have any thoughts?
I mean, I think what you're seeing in Miami and in Florida is characteristic of the hot parts of the country. You know, it's not happening in Joplin, Missouri, but it's happening in the money centers, it's happening in New York, it's happening in Los Angeles, in California, where people want to live, and which are really part of the global economy. The parts of the country which aren't part of the global economy, which have lagged, which are part of the Rust Belt, which haven't recovered, those parts you're not seeing the same building boom and the same real estate boom you're seeing in say, Miami.
You know, that raises a really good point, and that deals with, tie two things together. In New York, okay, two things are happening in New York. One of them is that there is a massive building boom going on, not in Manhattan, but outside of Manhattan, in one of the boroughs. In this case, it's Queens. And if any of you are familiar with Long Island City, and if you haven't been there recently, you would not recognize it. The high-rises that are going up, multi-purpose high-rises, are frankly massive. There's a significant number that are there. I don't know to what extent, I think Tom's point is an excellent point in terms of the larger context that's here. But there is another dynamic here in regards to real estate, and it's a little bit more in the political realm, and it's once again, one of these things that you really can't quantify, okay? It doesn't fall into the, the CAP-M, okay? And I don't know how many of you are familiar with this kleptocracy initiative by the Hudson Institute, okay? Oligarchs, money flows, Putin, Ukraine, you can go down the whole list. It's serious, and it's there. And if you want to understand a greater dynamic of what's going on with other countries and money and even into the United States, it's called the Kleptocracy Initiative by the Hudson Institute. A couple of guys there are running this thing, and they write some really, really good stuff. So again, it falls in the category of it's hard to quantify, like behavioral finance. You really can't quantify it, but we all know it's there, and we all know it plays a dynamic in it, and to whatever extent this can help inform you with decision-making, that's something that you might want to look into along with Kirk Cousins' touchdown dance. Okay.
I would just say don't underappreciate the value of your tax structure here. Because, with the SALT deduction caps, Trump basically put a bullet in New York and California. They're done. They're done as we know them. Everyone's leaving those states. All the rich people are going to leave first, and then the tax rates are going to have to go up more, and then everyone's flooding out. So you look at places like Florida, and you look at places like Texas, right? Especially as we have these massive deficits, and we have no deduction on 15% taxes in New York on the state level, and then that federal rate's going to start moving back up. You just have no incentive to stay in these places. So, just coming down to Florida, I would say, yeah, you're probably going through a boom. If anywhere is going to keep going through a boom, it's Florida and Texas and these places. Your population is going to keep growing. So I don't know that local market dynamic, but I know that those massive, very, very wealthy states, people will be moving in droves down to Florida and Texas in the next 10 to 15 years in a way that I don't think people are ready for.
I would think also the boat business would start to develop too when the rising seas come.
Yeah, maybe.
Okay. All right. Closing comments, okay? A thought that our panelists would leave with you. An area we discussed, we didn't discuss. Some topic that you'd like to leave with everyone here. Tom, why don't you give us your closing comment, if you would, please? And you need the microphone.
I think you've heard sort of my prediction. It's not really a prediction. It's just based on what the credit agencies are saying about the default rates, you could have something of a run here for a few more good months. You've heard Ali's prediction, which I don't disagree with, that next year, certainly the next 18 months, could be really troubling. It's tough as nails to predict the market. I think it's a near impossible task. And what's really important here, I think, is to play good defense, know that we've had a tremendous run, and know that we're likely getting close to the end of a cycle, but who's to say when it's going to occur? And so I think what's critically valuable, whether it's alternatives or just straight assets, is the asset allocation decision. And to really think how you want to allocate, how much you want to have in cash and how much you want to have more aggressively, and to try to balance that opportunity cost with the risk of the downside.
Terrific. Okay, sure, Chris.
We didn't talk much about this, but it's seemingly on everyone's mind that I've talked to in terms of managers and companies, is this ongoing trade war that the United States and the Trump administration had seemingly declared on everyone that had an economy that mattered. And I think what we've seen, say what you will about Trump, we've seen a major pivot, and no one's talking about it. And that major pivot is he came to the conclusion that you can't have and win trade wars against the entire world at the same time, even if you're Donald Trump. And so what he recognized was that he should bury the hatchet with most everyone. So he started with Mexico, and then Canada, and then buried the hatchet with Juncker, or at least decided on a ceasefire with him on the automobiles, and is focused on China. And I think the Chinese are miscalculating based on the midterm elections, thinking that if the Democrats do take the House and or the Senate, that they would be in their camp, and I think they're not. I think this is one of those issues where both Donald Trump and Bernie Sanders are on the same page, and they would be united against China in this sort of trade war issue. And so I do think ultimately before 2020 this thing does get resolved. If you look at what tariffs were prior to the trade war breaking out, there's a great chart. If any of you subscribe to Strategas, they put this out. If you've not, you should take a look at this. But if you look at developed economies, the U.S. had the absolute lowest tariffs at about 3, and Chinese were the second highest at nearly 10. And essentially, the administration has come to China and said, listen, our goal is to keep tariffs as low as possible. We're at 3. We'd like you to be there. If that's not the case, then we'll match you at 10, and that's where we'll be, and it'll hurt both economies badly. I think it ends up getting resolved. I think the Chinese are somewhat of a paper tiger because they recognize they need us. There's no one that can pick up the slack. The Japanese can't do it. The Europeans can't do it. And so for everyone's benefit, this hatchet will get buried, I think.
Okay, hopefully not in somebody's chest. Okay.
I just want to close with, our economy's basically been rate driven. If you take a look at rates from 1980 to now, they've basically been straight down. Only the past, 6 months, they've been ticking out, and now they're starting to tick out of that 30-year downtrend. And if rates continue this rise, the economy is going to be different than it was over the past 10, 15 years. I am a specialist in, gold stocks, gold companies. I'm not always a bull on gold, but I think the stars are aligning right here. The question was about personal portfolio. I've invested in the minor. I have not invested in the miners for a few years here, but I'm starting to, look at positions and build positions here. A small portion of your portfolio allocated towards gold is a safety play. When stocks don't do well and bonds don't do well, God forbid, gold usually does well. So it's a good diversifier.
And Ali.
I think just being defensive is not just to be defensive, it's so you could be offensive later. So don't forget that, right? And as you're sitting here figuring out that defensive position, it's, you work just as hard, but you work at what will I do next, right? And so I think I'm excited. I think it's an exciting time. I think obviously drawdowns are difficult, but if you do the right thing, that's where you make the most money, so.
Okay, terrific. And my closing comment, not to be offensive, is, the puns are not working tonight. All right. First of all, thank you all for coming here. Thank you for hosting this event to the Society once again. Thank you, Phil. Please do come on January 16th. I have the privilege of moderating that event, and we should have a really good program, outlook for the year ahead, that type of thing. And I ask all of you to please join me in thanking, well, I want to thank Mark also, does a great job. Everything gets posted up on the website. Absolutely terrific. And I ask you to please join me in thanking our panel for a really excellent discussion. Thank you.